All right, guys, welcome back for another video. In today's video, I want to do a quick rundown on the stochastic indicator. You guys probably noticed that I don't really use indicators that much in my videos, but I think sometimes a simple understanding of what they represent can help people, especially people who are a little bit new to trading or aren't familiar with volatility or trend parameters. So right now, I just have the stochastics on my chart, just the standard 1436 default settings. And what this indicator essentially shows you is a waning momentum in the market. So typically it'll tell you that a trend, or the way I use it is to tell me when a trend is nearing its completion. And here, the areas you want to pay attention to mainly, when you have your default settings on the stochastic chart, it has a lower bound at 20 and the upper bound at 80. And you want to pay attention. I would go so far as to say ignore everything within the middle bands, and focus solely on only the distinctions on the upper and lower, beneath the 20 level and above the 80 level, and look for the price distinctions there. So when price, and essentially what that represents is price hitting extremes. um, and if the market rarely maintains extremes, even if it's going to maintain extremes, it'll cool off for a little bit, reset, and then continue pushing extremes. So in situations like this, so you've had a massive bear market here in 2018, you can see that, and then it comes down here, and then you come down to this below the 20 bound, and then you begin to cross up right here. And then you see a rally ensue up into the middle. Again, this is not really the significant area, but you can see it crosses up down here, right here, breaking these lows right here, setting in this low structure right there. And of course, this is a monthly chart, so you really don't get. I'm really not paying attention to the cross right here, right, because it's in the middle. I don't really care. I don't see that. That's just noise, in my opinion. You don't get your final read until up here. And again, here you can see, here's a sign that momentum is waning, right? Again, that's not the entire top here. Um, you cross down here, and you still push new highs, come down, push new highs. But the point is that momentum is waning, right? So the market shifted around there, right? Where from it was, a total massive bull trend, and then the stochastics cross down, and you get more of a range bound market. I know it doesn't feel like that right now. We're crashing totally, but for all intents and purposes, price has been within a range bound area from 30K to 60K for a better part of a year, better part almost 2 years actually, which is kind of insane. But and you can see the same characteristic on the weekly weekly price action. See here, we again, I've documented this Wyckoff formation. You can see it on the daily better, but you have this multi-month Wyckoff distribution, multi-month Wyckoff accumulation, and then you get your Wyckoff spring, and then you see at the spring, the stochastics are down here the whole time, and then they cross up here, cross up at the lows, kind of like what we saw at the monthly, when the monthly crossed up at 3,000. And then it runs all the way up, um, right here. This for all to be fair, this is a massive stutter step right here. One that probably caught a lot of people off guard. So you know, price essentially came here and then set in what at the time when this candle closed here, people were looking at this as a higher low on the weekly relative. Excuse me, a lower high on the weekly relative to this, looking for lower prices. You have stochastics crossing down. So it's not the point of the stochastics is not to, and momentum in general, is not to formulate a strong risk on perspective, but to use it as a framework to manage your own expectations about the market. So even though, the market didn't, stochastics came up here, crossed down, the market didn't sell off immediately. It did, the market was near to the top, right? And you see that momentum slowing down. And actually, these are some of the best signals in stochastics when you see a fake out like this and you see it cross down and then run back up for liquidity one last time, run back up and then cross down like that. That's a signature where a lot of people in the market, for obvious reasons, are caught up in that gyration and caught offside. All right, and then going down to the daily, this is less of a area of interest on stochastics, just because there's really no clearly defined trend here, right? You have the highs taken out above here, and then the lows taken out below here. So you have this. Break of structure right here, right? Because the daily was in a very clearly defined downtrend, and whenever the daily's in a clearly defined downtrend, right, the stochastics crossing down is going to be a good signal, right? So you really only got one in this downtrend because this was the start of the trend, right? You started breaking structure after the stochastics crossed down, so that wasn't really a signal. You really only got one where stochastics did barely come up above the 80 read. Again, this is very heavy sell pressure, so you really didn't get extended up into the extreme areas, but you did officially get the blue line crossing over the 80. And then it came down and then put in a top here, crossed down out of the 80 level on stochastics. And you can see that was a high in the market, and the market continued trending until it broke structure here. And then the market, you started essentially taking out the highs, whereas before you were just violating the lows. And then price enters this consolidation period here, marked by higher lows and lower highs. And this is why I think it's not very relevant, because on the daily, you don't really have trending behavior right now. You have some very high time frame stuff going on with volatility parameters, because you come up, right? You set the daily looked like it was trending to the upside, creating higher highs. So it runs up above these highs, knocks everybody out of the market, and then runs down below these lows. So you have higher highs, lower lows. That's really wild to see on a daily chart. I mean, you typically see this pattern on like an hourly or a 15-minute chart, near some high time frame level where volatility picks up and you stop people out of the market. But to see that on a daily, I mean, there's clearly something high time frame going on right now to see that signature on a daily chart. Now let's go down to a 4-hour. See how this can be applied to a 4-hour chart. Yeah, so in the 4-hour, you have a much more clearly defined trend, whereas we didn't really have it so much on the daily. But on the 4-hour, yeah, you get come up here. Essentially, you come down here. This is what we would call a price shelf, right? Price comes down to the shelf. At this point, you're looking at price, and you don't know um, if price will continue on, go upward and onward. Um, so if you were short, you really want to take profit at this area, just because structure has not broken yet. It's only until price comes down to the shelf, rallies off the shelf, comes back up to the point, the point of origin right here, sells off. But it's not until we break these lows here that this creates an apex formation, and then you have a clearly defined trend on the 4-hour chart. So you don't have a signal until, right, we don't have the trend until these lows are taken out, and then you see the lows get taken out, and then almost fill the extension, sell off. Um, these are probably 618 retracements within here that you could play. But, essentially what we're paying attention to now in this video is the stochastics. You can see here, price came up above the 80 level, came down. You didn't get a great play, but you did get a run. The stochastics turned down, momentum resumed the trend, and then you get a run below the liquidity below the lows here. So you could have played that trade from there to there. Let's see, and then price runs up again. Price runs up, hits this level. You get price crossing down from the 80 read. So again, it's not an immediate area to take a short, right? Because price crossed down here, and then it ran up once more above the highs. It's just a sign that the counter trend momentum is waning, right? Because we're in a downtrend. And then you see this level. It just tells you that the counter trend movement is fading. The greater trend's probably going to take over, even if there's one last liquidity run. And then you see that price comes down here, and then you get a similar. This is not really that tradable, just because you get a quick move down here, down below these lows. I mean, you could have traded it. It technically would have worked out, but not the best situation. And then really you get an ideal situation here, which is, you had the FOMC meeting, and then price where Jerome Powell announced the interest rate rise. And you see a brief run above the liquidity here. And, then you hit the 80 read, cross down from the 80 read. That would have been an excellent trade. Of course, there's a lot more going on here than just the fading of momentum in stochastics. So while this might look like an ideal trade, again, this is really a lot more going on there than just the simply the stochastic indicator or the waning of momentum that it indicates. And an important thing to mention is if you are going to trade stochastics, is that you want to keep the trend in mind, right? So here we have a very clearly defined downtrend, right? That goes without saying, at least on this time frame. And what you want to avoid is trading any counter trend reads, right? So when we're in this counter clearly defined downtrend, price is coming down to the extreme at below the 20 level and crossing up, but we really don't want to pay attention to that, because in the context of what volatility is doing, and what the trend is doing at that time, again, it just doesn't represent an edge. It's just noise. But when it gets to extremes up in line with what the trend and what the volatility is doing, there probably is a little bit of edge there. Of course, you want it to line up with what other things you're seeing in price action itself, right? So maybe a good example here, right, is like, you've identified this downtrend, price comes up to this extreme level right here, and then you see the counter trend momentum is waning a little bit. So maybe you go down to the 15-minute time frame up to that level, and you look for a setup on the low time frames, right? So you get this spike up right here, and then you start violating the lows right here, right? So maybe maybe you enter at market here. Again, that's not very tradable, just because you really don't get a retracement. Price kind of just sells off. You could conceptualize a trade here. So price comes down, closes below here, gets a test up into that level, and then sells off from that level. And then so you have this level here. You could put a stop above that high, and you have your position entered there. That sells off, and then you have stop above there. That would have been one way to trade this. Of course, I didn't play that trade. Hindsight is 2020, but that would be. It's just an example of one way to use the lower time frames in the context of some higher time frame idea, and use them to be more precise with your entries and exits. Anyway, I hope you guys like this video. If you like this type of content, just make sure to like the video, subscribe to the channel, and stay tuned for more uploads. Catch you in the next one.